I use 3 technical tools: trend lines, moving averages, 100 and 200 Fibonacci retracements. For instance, let's take a look at this chart, and this is at the beginning of this month where the volatility really started to take place. The market started to move up and down and up and down. But at this point right here, can you define your risk against this double top right here? Yes. Can you anticipate something may happen? Well, either the market's going to go this way or it's going to go that way. Right now it's showing a direction to the downside and actually gives you the clue right here. When the market hits the peak right here, the market started to move down. And as you can see, we moved down to where a support area right here. And this is what you as a trader have to start to do in these types of markets, is anticipate a move lower, define risk against the double top. Market moves 100 pips in over the next 4 hours. You take it and you run. You don't become married to the position. You like it. All right, let's move a little bit further and take a look at this line right here. This is a trend line, and what do we have here in these in these volatile markets? You can also just draw trend lines against lows. We have 1, 2, 3, 4, 5. You can see here how the market low this line starts to develop here over time. Well, I'm talking about this period here where the market starts to rebound, moves to the upside. Can you not draw a parallel trend line that takes 1, 2, 3, 4, 5, just come up and connect it to the high over here and see when the market starts to move to the upside, anticipate that there may be something that may slow, that this may be something that may slow the market down at this point right here? Can you anticipate, or at least know that that line is there, and if the market starts to move down and maybe gets below this line right here or moves in this area, holds this level right here, that maybe it's time to be patient, that patience that you've been having, that reason to a trade is something that you can take advantage of. Take advantage at this point. Despite the volatility that the market's having here, despite all the news and stuff, traders always look to define their risk, to find levels that they can trade against. And that's what you as a retail trader have to do as well. Define that risk. Define that risk against a line there, even if it seems so remote that it's so far away, but you take this line, you connect it to a high here, and you put it in there, and you say, oh, well, what happens? Well, look what happens. The market starts to slow down at this area. Can you see the market slowing down? This is an hourly chart here. This is 4 hours here. Beginning of the day, the market is slowing down at that level. It's defined this. It's defined that. Where is your risk if you sold the market against this level? Right here, right here. Let's take a half a box here, okay? Let's define our risk as a half a box there. And if you sold the market at this level right here, if you had that trader's luck and came in the market and thought, hey, you know what? We just came all the way down. We came all the way back here. I'm going to sell against this trend line. This is going to be my trade, and let's see what happens. I can define my risk as a half a box here. This half a box right there, I'm going to define it against there. And if I make a full box right to this point right here, I'll be happy. Oh, well, how about 2 full boxes? How about 3? How about 4, 5, 6, 7, 8, 9? These are the types of things that these types of markets may allow you to do. So then I say, well, okay, you don't want to marry a position. You want to, you like a position. So when the market comes down here and it goes down 1, 2, 3 or so boxes, what do? We get a big move to the upside. Well, we start to use other tools in this process as well, including the 100-bar moving average here. The market moves above that level, and you take your profit at that point. When it moves back below the 100-bar moving average, what does that turn your bias to? Are you still bullish or are you now bearish? Well, this is the importance of using what I call unambiguous trading tools. Trading tools that give you either a bullish bias when the price is above or a bearish bias when the price is below. Obviously, something came out at this point right here on this day, August 4th, where the market took a sharp move to the upside and then came right back down. You should use that idea or use these tools as ways to take profit and then maybe even get back on the trend, and hopefully you catch even more of this trend, or at least recognize that the bias is to the downside. And don't trade against the trend. Look to trade with the trend on the way to the downside. And then you can stay married to the position, have the position move further to the downside. Okay, let's move Move on to the point number 6 we saw in this previous chart right here, where the market came down, and where do we come down to? Well, 1, 2, 3, 4, 5, and now we have, well, 6 down here. The market came down to our support level against our support trend line. These are all in the volatile markets, the news-driven markets that we've developed here. And what we saw here, point number 6, is that the market did move below that level. And if you were astute, or if you're a trader and you're short from up here, moving below that level may prompt you to sell some more. It may also prompt or a trader to actually think about selling the market, because we're breaking through this key support level of 1, 2, 3, 4, 5, 6. But what should a good trader also do when they trade against a certain key level? Also, after we come down a pretty good ways here, this is about 300 pips to the downside here. What should a trader realize as well? Excuse me, and that is that the market may stall as well at this level. And if it stalls at this level, what do you have the potential to do? Find some support against that level, just like we found resistance against this level. And lo and behold, the market moves a little bit below that line here. May have stopped some people out who may have bought against that support line. But when the market starts to move back above this level, what are you doing? You're getting out and perhaps even thinking about, well, maybe I'll play for the corrective move, 38.2 of this move or whatever. What does the market end up doing? Rocketing back to the top side here. This is the Friday before the S&P downgrade here. If you kept the position open over the weekend, the S&P downgrade, the market moved further to the upside and started its move back to the downside. So trend lines are one of the technical tools that define risk. By defining risk using trend line, traders can start to anticipate a trend. They can also are able to do what I call keep fear to a minimum. If you can define your risk, you can limit your risk as well, and that is what you as a trader start to try to do, is define your risk, keep your fear to a minimum, and in the process you make trading a little less difficult. It's still difficult, but a little less difficult. I use 100 and 200 bar moving average. 100 is blue, the 200 is green. We already talked a little bit about it. The 100 I call my trigger. Trades are initiated there. The 200 is what I call my confirming. It helps confirm the trends. Moving averages are also unambiguous. They help define your risk. They allow you to keep your risk to a minimum, and because risk is limited, fear is reduced. Keep your fear to a minimum, folks. Fear is a trader's worst enemy. If the trend is your friend, fear is your enemy. Trade. Be cognizant of your fear. Traders can anticipate a potential trend or a breakthrough a moving average. So here's our moving average. We're looking at the same charts. The market broke through the 100-bar moving average here at this point right here. It gave you a trigger to sell. The market confirmed through the 200-bar moving average, moved to the downside. What do you do here when the market breaks above the 100-bar moving average? Well, that's giving you a buy. Hopefully you're buying. You're buying more toward this area as well. But note here, what else is happening over at this point? Remember when we looked at those trend lines here, and we're looking at the first trade where the market had a double top there. Now we introduce another technical tool in the picture, and this is the 100-bar moving average. So when you're trading in volatile markets, if you have multiple reasons to trade, is this a way that increases your confidence in the trade? And the answer is yes. So look for multiple reasons to trade. We're breaking above these double top right here, which sent the market to the downside. We're also breaking above the 100-bar moving average. Not far away from that double top. You can see how the market came up to the double top area initially, moved a little bit to the downside here, and then regrouped and said off to the top side here. And so this was an opportunity for you in this volatile market to take advantage of not only breaking above the double top, but also breaking above the 100-bar moving average. Look for those multiple reasons to trade, folks, and they'll provide you with good trade location in your trade, allow you to good to great trade location, allow you to profit from it. Now, the other thing that I want to point out is that when you get in a trade and the market starts to move in your direction, what do you do for then? You have good trade entry, and that's part one of a trade. Now you have to manage the trade. And part of managing the trade, especially in these volatile markets, is to make sure that you get to your next targets.